Welcome to Pankinen Financial Perspective with Ashton Pankinen from Pankinen Financial Group. Planning for your financial future means navigating challenges like market volatility, inflation, and retirement income. Pankinen Financial Perspective is here to help by addressing common financial concerns, sharing valuable strategies, and exploring ways you can work toward your financial goals. Now let's get started with Pankinen Financial Perspective.
Hello and welcome to the Pankinen Financial Perspective. My name is Ashton Pankinen from Pankinen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 952-873-2703 or visit us online at pankinenfinancial.com. That's PANKONIN financial.com. And while at my website, click on the radio page to check out past shows and to subscribe to our program on Apple Podcast, Spotify, or Amazon Music. Also, while at my page, click the link at the top to get the latest retirement guide. Today, we're talking about something that's on the minds of a lot of people right now, and that's what the next year markets could look like and what it means if you're preparing for retirement or already relying on your portfolio for income. After years with positive returns, it's natural to start wondering whether the environment ahead will feel familiar or very different. If you've been thinking, I'm grateful for the gains, but I'm not sure how much of this I should expect going forward, then this is the conversation designed with you in mind. To help frame the discussion, the data and information we'll be referencing throughout the show today is from a recent article in U.S. News and World Report titled, What Do the Markets Have in Store for Retirees in 2026? It looks at recent performance, current expectations, and how retirees and near retirees might think about the year ahead without falling into the trap of prediction. And as always, I'm joined by my co-host, Tony Shore, who's here to represent the listener at home and make sure we don't lose anyone once the conversation gets a little too technical.
Right. I'm here to translate, right? I mean, basically. And of course, I'm here to interrupt you when you're talking about something important and bring up pizza. I mean, that's really my role on the show. I think most of our listeners and viewers understand this. Math, technical stuff, handled by Ashton. That's where it's at. Well, Ashton, I've been great, and I want to thank you once again for letting me participate in the show each week. I absolutely love being here. And I usually, despite myself, manage to learn something from you. Very educational. That's good. Yeah. I know you've heard from a lot of our listeners out there who enjoy listening to the show with questions. And they've learned a lot, rethought their positions on things, and really taken time because of your advice to stop and look at where they're at and what they need to get done. So, for sure. And today's show is really good. It's 2026 is going to be a big year. And I think for all of us, but especially retirees or those thinking about retiring soon, this is going to have a lot of impact. How have you been, though? You've been busy. You're doing work on your office building there. You're doing some construction work.
Yeah, we're creating a front reception area here at the office. We didn't really have one before. We're right in the midst of that. And so I told the contractor this morning during the recording that, hey, you got to keep it down for a little bit here. And we're doing that. We're excited to have that done. Hopefully it'll be done mid-March, end of March. But we all know how that can go sometimes. So maybe April is the real goal.
Sure.
No.
Yeah, I'd add a couple of months to that.
Yeah. No, it's going good. And then, we've been really busy at the office here too. It's tax planning time of year here. And so whether we're looking at planning for last year to see what we can do to reduce taxes for 2025 or also at the same time looking at 2026 and seeing what we can put in place to help reduce those taxes.
Yeah, I know part of what you do as a financial advisor is looking ahead for people in retirement or if they're planning for retirement at future taxes. That's tax planning to minimize that tax burden in the future. And of course, you work alongside CPAs and tax professionals who are tax preparers who are looking back in the rearview mirror at the past year and saying, okay, what can we do before the end of this year to put you in a better situation? And, what do we need to look at for last year's taxes, right?
Yeah, it's very important to have that open communication with those tax preparers, those CPAs, and make sure we're all on the same page.
Yeah, I would agree. So I know that saving for retirement, for those who have already retired and are taking income, the last few years have been pretty favorable, right?
Yeah.
I mean, the last 3 years, the markets anyway have been huge.
Yeah, that's another thing. For many, it's been a strong stretch by almost any historical standard, especially for those investors who have stayed disciplined and focused in the long term. It's one of those things I'm reviewing when we sit down, and I'm kind of preparing people that it's not always going to go this good.
Right.
I'm not saying it can't. The crystal ball is a little fuzzy for me there, but again, it's something that I prepare that it's not always going to be these types of returns. If you take a look at the S&P 500, which many people use as a broad barometer for the stock market, it returned 16% in 2025. And then you look at the past 3 years together, the annualized return has been roughly 22%. And so for those kind of results are well above what markets have delivered for many decades.
Which naturally leads people to wonder how sustainable that all is, though, right?
Exactly. After a run like that, it's reasonable to ask what comes next. And that's the attention that starts to turn toward 2026. I've spent time reviewing forecasts from a variety of different financial firms. They're not exactly gripping reads, but together they do paint a fairly consistent picture. Most are calling for another positive year in the markets, just not at the same pace we've seen recently.
Yeah, that's true. So more growth, but with tempered expectations.
Yeah, that's right. Along with moderate return expectations, many forecasts also point to increased volatility. We've got a reminder that last year when the markets dipped in April following the announcement of a new important tariff regime, those periods can be uncomfortable. And in this case, investors who stayed invested saw the market recover and finish strong in 2025.
That kind of short-term volatility, I think it really tests people's resolve, doesn't it, Ashton?
Yeah, it can, and it's also a good reminder of how unusual the past years have been from a historical standpoint. The article notes that 2025's market strength pushed the S&P 500 toward one of its best rolling 3-year returns on record. And, it also noted that the market, if it were to deliver a fourth consecutive year of double-digit returns in 2026, it would be something we haven't seen since the late 1990s in that dot-com era. And that's why forecasters start to differ when it comes to what might actually drive returns going forward. One of the biggest points of debate right now is the role of artificial intelligence, AI. It's a big talking point for everybody. Over the past few years, AI-related spending has fueled significant gains in large technology stocks, contributing an outsized portion of the market's overall return.
But that leadership, it may not look the same this year, right?
Yeah, that's what many analysts are suggesting. Some believe that AI may account for less of the market's returns in 2026, which is why you're seeing more interest in value-oriented stocks and non-U.S. investments in certain forecasts. That said, most aren't dismissing AI altogether. The expectation that AI can help a wider range of industries improve efficiency, and maintain that profitability still underpins many outlooks. So it's just that the benefits may be more broadly distributed. So again, not just tech companies, but overall efficiency of different companies due to AI.
This whole AI thing, it is fascinating. And, some people say, oh, it's a bubble, it's going to burst. It's like the dot-com bubble, but it really isn't because there's more substance behind it. There are actual companies who are producing things and not just made up web addresses getting hundreds of millions of dollars in venture capital and hitting the stock market, like pets.com. Remember that fiasco that really had nothing to offer. They had no business. They had no, income, but they had a great idea or a good web address. So they got funding and they went public. It's crazy. That was crazy. We're looking at something different with AI, not that it won't see a dip, but I agree with what you say there. So let's talk about what all of this actually means, though, Ashton, for retirees.
Yeah, that's a key question. For many retirees, the approach to investing naturally changes over time. As people age, they often shift away from aggressive growth more towards preserving that capital. And that can mean dialing back exposure to stocks and increasing allocations to fixed income investments like bonds, along with maintaining some cash reserves for emergencies and then those planned withdrawals.
that's where the familiar balanced portfolio idea comes in, right?
Yeah, precisely. The classic 60-40 split between stocks and bonds is still a common benchmark for many investors. And it's one that a lot of retirees reference as they think about risk and income. And that said, how much income you need and the size of your overall asset base matter a great deal. There's not a one-size-fits-all approach here, Tony.
Well, and especially that 60-40 split rule worked for a long time for many people, but really the old rules really didn't apply. Plus, like you just said, everybody's situation is different, so you can't use a one-size-fits-all approach. But even with the shift towards safety, and I know you make sure your clients have a balance of risk and safety. Stocks don't disappear entirely from the picture, right? You have to have some risk and growth, right?
Yeah, they really shouldn't disappear entirely. History shows that equities tend to outpace other asset classes over long periods of time, which is important even in retirement because people are often planning for decades, not just a few years. So again, hopefully when we retire, we've got that 10, 20, 30-year retirement that we want to plan for. And so maintaining some exposure to stocks can help portfolios keep up with that inflation and support long-term purchasing power.
Yeah. On the other side of the equation right now, bonds may be having a moment, actually.
Yeah, no, they may be. The article explains that Vanguard, one of the world's largest mutual fund providers, has expressed optimism about bonds in the years ahead. The firm has said that it maintains a long-term view on high-quality bonds, both taxable and tax-exempt. They can offer some attractive real returns in the current environment, particularly given the higher neutral interest rates here.
Yeah, and that's not something we've heard a lot about over the past decade, though, is it?
No, it isn't. And that's what makes this noteworthy. Vanguard forecasts that the high quality U.S. bonds could return about 4% annually over the next 10 years, which is what we believe could provide that comfortable margin above expected inflation. We expect inflation to be a little lower. So for retirees who rely on that predictable income and stability, that kind of outlook may actually play an important role in their portfolio construction.
Well, it's less about abandoning growth and more about balance then, isn't it?
Yeah, nicely put, Tony. It's about combining growth, income, and stability in a way that supports retirement goals without taking on more risk than necessary.
Another theme I think that always seems to come up when we're talking about the markets is the Federal Reserve. And we've heard a lot about this lately, right? The Fed, interest rates.
Yeah, and it does. It comes up and for good reason. Investors have a long time they've paid close attention to what the Federal Reserve is doing because that's the interest rate policy can have a meaningful impact on both the economy and the stock market, and then bond rates as well. And so when interest rates are rising, often in an effort to combat inflation, stocks can face headwinds. And so then borrowing becomes more expensive, economic growth can slow. And then on the other hand, when rates are being cut, as they are now, it tends to create an environment where stocks have historically performed better.
Yeah, and I think that's why the administration has been putting pressure on the Fed to keep lowering them. And lower rates can act like a tailwind here, right?
Yeah, correct. And that's why many market watchers subscribe to the old saying, don't fight the Fed. But with that said, again, like you said, there is some uncertainty around the Fed right now with Jerome Powell being done in May. And, recent votes on monetary policy have shown some disagreement among those policymakers about the future path of these interest rates.
So not everyone at the Fed is seeing things the same way then.
Yeah, exactly. You got it. Despite that internal debate, market expectations remain fairly consistent. Many investors are currently anticipating 2 additional rate cuts, which at least historically would be viewed as a support for equities.
And some strategists, I think, last year set the stage for what comes next then.
Yeah, they do. The article notes that Jaron Timmer, director of global macro at Fidelity Investments, has suggested that the market's performance in 2025 helped lay that groundwork for potentially positive 2026. He described in 2025 as an unusual year marked by competing forces with things like tariff-related headwinds and on one hand, and then support of the Fed policy on the other.
Well, it's true. We had last April, 2025 April, I think we all remember that, almost like a 19% drop in the markets, and people panicked. Some people wanted to pull out completely, like,
great time to buy.
Move me to cash. Nope. That's you do the opposite then. You don't pull money out of the market when it's down. You got to buy if you can at all, or stay the course. And those that stayed the course, they really won because it hit record highs and has been so since then. So a lot pulling in different directions at once, though, with the Fed policies and tariffs and other things, right?
Yeah, and despite those cross currents, Tony, several factors have helped support the market. One is being described as capital expenditure or CapEx boom, where companies are making significant investments in equipment, technology, and infrastructure to support future growth. Another is that bond market that we talked about. When risks are rising, bond markets often become more volatile or signal stress. So, they've remained relatively calm.
They have, and that probably says something about the broader picture, correct?
It does. Taken together, these factors have contributed to a market that has shown us a surprising level of resilience. And that resilience is a big reason why many forecast remaining cautiously optimistic heading into 2026.
Yeah. Now, before we keep going with our conversation today, Ashton, let listeners out there know how they can get a hold of you or schedule that no charge, no obligation consultation.
Yeah, the best way is to give our office a call, 952-873-2703. Again, that number is 952-873-2703. Or visit us online at pankinonfinancial.com. That's PANKONIN financial.com. Scheduling a consultation only takes a few minutes, and we're always happy to work around your schedule.
And, we've been talking about a lot today. Let's jump back into it. You mentioned some forecasts dialing back expectations a little bit for AI, but not everybody is backing away from it. And overall, I think a lot of the talking heads out there and folks on Wall Street are pretty bullish about this year being an up year.
Yeah. Yeah, and while there's debate about how much AI will contribute to market returns in the near term, many firms remain constructive on their longer term impact. Again, iShares, the exchange traded fund of BlackRock, continues to view artificial intelligence as a major driver for growth, while also seeing opportunities for other sectors to perform well this year. And so again, it's not just our technology; it's these companies using AI to improve their overall, lower their expenses and increase efficiency is what I was looking for there. So, So again, it's hard to ignore the scale of investment. More than $500 billion was spent on data centers in 2025 alone. Again, that's billion with a B. And estimates suggest that total AI related infrastructure spending could be between 5 trillion and 8 trillion by 2030.
That's trillion.
A lot of money going into
AI-related infrastructure in the trillions, which is impossible for most of us to even wrap our head around that number and what that actually means. Those are big numbers.
Big numbers, yeah, they are. And they matter. The level of capital investment support is not just corporate profit expectations, but just broader economic growth as well. So even if AI leadership becomes more dispersed across sectors, the underlying investments remain in meaningful force.
And that brings us to a very practical question for our listeners out there, which is, what should they be doing right now?
This is where regular portfolio checkups come in. The start of a new year is often a good time to step back, review retirement investments, and make sure they're still aligned with your goals. After 3 years of strong stock market performance, many portfolios no longer resemble what they looked like in 2022. Rebalancing may be necessary just to maintain the same target allocation you originally intended. I actually just sat down with a client the other day. They had a goal of they thought they were 50-50 balanced as far as 50% stocks, 50% bonds, but then their portfolio actually drifted to 70% stocks and 30% bonds because of how well equities have performed the last few years. And so if that's not the risk they want to be in, it's a good time to rebalance.
Well, and that's before you factor in all of the changes in personal circumstances, right?
Yeah, you got it. Needs evolve over time, especially in retirement. As people age, they may begin with drawing down more on their capital, which can change how risk should be managed. And it's important to reassess your tolerance for risk potential loss. That assessment should be grounded in your income needs and not just your overall asset levels.
Right. But that doesn't mean stepping away from stocks entirely once again, right?
No, it doesn't. Even in retirement, you want to maintain some exposure to those equities. It can be very important. Historically, stocks have provided higher long-term returns than many other asset classes, which helps portfolios keep pace with inflation over time. I like to think of it this way. The goal isn't to chase money you want, it's to invest thoughtfully so you can have the money you need.
Well, and that's exactly. We've covered a lot today already, including markets, volatility, interest rates, AI, bonds, and stocks. I think for some of our listeners out there, it might feel like, okay, I get the big picture, but again, what do I actually do with all of this?
Yeah, that's a very real reaction. And honestly, it's one of the main reasons people choose to work with a financial advisor in the first place. Not because they don't understand any of this, but because it's hard to translate market commentary into an actual strategy that fits your life.
Right. And there you go. A strategy that fits your life. That basically says it all.
Yeah.
So headlines are one thing, personal decisions are another.
Yeah, I couldn't agree more. Market forecasts, Fed policy, AI investment trends, they're all useful context, but none of them tell you how much risk you should be taking, how much income you can safely withdraw, or how your portfolio should be structured given your goals and your time horizon. Again, a financial advisor helps connect those dots.
Yeah. That's really good. Now, instead of reacting to each new forecast, that way you're stepping back and looking at the whole picture. That's what you're saying.
Yeah, that's the goal, Tony. One of the biggest mistakes investors make, especially for a strong run like we've had, is assuming that recent performance should drive future decisions. It's easy for someone who's been a little more conservative to be a little more aggressive because we have had market returns. But again, we want to focus on those strategies, not just the headlines.
And that seems especially important for retirees or people getting close to retirement.
It is. When you're actually accumulating assets, volatility feels different. When you're drawing income, the stakes change. Market swings, interest rate shifts, and asset allocation decisions all have more direct impact on your lifestyle. So again, working with a financial service professional helps frame today's market environment in terms of income sustainability, not just overall returns.
Okay, so instead of asking what will the market do next year, what does the question really become?
Yeah, I'm positioned to meet the needs regardless of what the market does. Is the question, am I able to meet my income needs? That's a much healthier and more productive question. Again, a financial advisor can help model different scenarios. What happens if my returns are lower? What if volatility increases? What if inflation stays elevated longer than expected? Those exercises turn uncertainty into something more manageable.
And that's not something most people can easily do on their own, is it?
Not realistically. Most people don't have the tools or the time to stress test their strategy across multiple scenarios. And even if they did, it's hard not to be objective about your own money. So again, it's hard to separate that emotion when it's your own money. Money is a very emotional thing. And so another key benefit of having someone who isn't emotionally attached to your portfolio.
Right. Because emotions have a way of showing up at the worst possible times.
Exactly. They do. Volatility, like we talked about earlier, can prompt impulsive decisions. Again, a financial professional acts like a stabilizing force, someone who can help you stay disciplined when the markets get noisy. And that discipline does matter far more long-term outcomes than perfectly timed decisions. So again, timing the market is nearly impossible. And so again, if the market swings, we want to make sure we stick to our strategy.
Yeah. And we also talked about rebalancing earlier. And I think that's another area where guidance from a financial services professional like yourself can really help.
Yeah, I think so. After several years of strong equity returns, many portfolios do drift from that original target without investors even realizing it. Rebalancing isn't just about predicting the market. It's about maintaining that level of risk that you choose. And statistically, it can help reduce volatility and give you better overall returns, having a regular rebalance of that portfolio. And so again, make sure you have an advisor that helps ensure that portfolio still reflects your goals, your income needs, and that tolerance for loss, not just recent performance.
Right. And that tolerance can change over time.
No, it often does. Life changes, health changes, income needs change. A strong financial strategy isn't static. It does evolve over time. And working again with an advisor creates a process for revisiting and adjusting that strategy as circumstances change.
So it's not just about investments.
No, not at all. Investments are only one piece of that puzzle. A comprehensive strategy also considers taxes, withdrawal sequencing, cash reserves, and legacy goals. For example, how and when you take income can be just as important as how your portfolio performs. And again, an advisor helps coordinate those decisions so we can work together rather than just cross purposes.
That's good. I think that coordination is especially valuable in a year like this where there's optimism, but also some uncertainty out there too.
Yeah, bingo there, Tony. When forecasts are mixed, think moderate growth, higher volatility, shifting leadership in the market. It's easy to feel pulled in multiple directions. So again, you want to cut through all that noise and answer the simple but powerful question: is your plan still on track?
Yeah. And if it's not?
Well, then you adjust thoughtfully, deliberately with context, not because of fear, not because of news headlines, not because of all the hype. That's the difference between investing as a strategy and investing as a reaction.
Which brings us back to something you said earlier.
Right. The idea of investing should be about having the money you need, not gambling on the money you want. So again, an advisor can help that perspective and keep it front and center. We help align your portfolio with real world goals, income, stability, and flexibility so market outcomes don't dictate your peace of mind.
So if someone's been listening today and thinking, hey, I understand more than I did an hour ago, but I still don't feel totally confident, that's going to be normal.
Correct. And it's also a good signal. Confidence in planning for retirement doesn't come from having all the answers. It comes from having a process and a partner. I always tell my clients, you don't have to understand it to the extent that I do. I hope you learn something every time we're in together, but that's why we have this partnership. And again, working with an advisor helps turn information into that understanding and understanding into action. And over time, that's what we build is stronger, more resilient financial strategies.
All right. Well, hey, great summary, an excellent show. Is there anything else you want to add before we go today?
Yeah, again, if you have questions about your retirement and your financial strategy, visit my website, pankoninfinancial.com. That's PANKONIN financial.com. Call my office, 952-873-2703. Again, that's 952-873-2703. We'd love to help you protect your savings and feel confident about the road ahead.
All right. Well, that does it for today's episode of the Pankonin Financial Perspective with our host, Ashton Pankonin.
Thank you for joining us for Pankonin Financial Perspective. Don't head into retirement without a plan for both your finances and your health. For more information, contact Ashton Pankonin at Pankonin Financial Group at 952-873-2703 or visit pankoninfinancialgroup.com. Join us again soon for another episode of Pankonin Financial Perspective. Advisory services are offered by Ashton Pankonin LLC DBA Pankonin Financial Group, an investment advisor in the state of Minnesota.
All matters discussed during the show are for informational purposes only. Each individual situation may vary and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.